Good morning. Welcome to the Thursday morning trade findings and adjustments for April the 25th. My name is Kevin Hurley. Glad to be with you today. And I'm just going to give you fair warning. This one is going to be entertaining because I'm a little bugged. I'm a little frustrated. I'm out here in beautiful sunny California. Love the place. Hate the politics. Hate the traffic. Love the beach. Love Facebook today. Love Disney today. I hopefully will love Ford by the end of the day, and I really wish Baidu and Apple would make a turn. What else can I tell you? Great Visa report. Sorry to see Visa's not getting any love. But with that said, I've had a couple conversations, and where's the Sinatra music? And to make it simple for I guess you guys to understand might be the best view or best explanation of what I'm going to say. Let me start off with trading rules, and I'm going to make this as simple as can be. For the most part, trading rules are for those who can't seem to think for themselves, want to be led around by the nose, and always want to blame something else on their bad trading results. And that's it, plain and simple. And I'm going to do the best I can to help you understand. When I have a conversation with someone during the week that says, well, there's a rule that says, the first thought that comes to my mind is, you dumbass. Why would you ever think that way and have it be finite? Because there are very, very, very few finite rules in trading. The reason why there are so very finite rules is because the market is ever changing, ever moving. It's a volatile beast. You can't, the only trade, in all honesty, that works every time is the collar trade. And that is because you have stock ownership, you have protected to the downside, and you have forever for things to come back. So if you want to be a, hey, I want to work every time, I want staunch rules, it has to be this way, the collar trade is the only finite rule-based trade that works every time but has no time frame. So there you go. Now you have it. What set this off for me is that simple rules are bendable. Like I don't like to trade the first hour, come on, Hurley. Markets are open. Now, if things are crashing, will I take advantage of a crash? Damn well better believe I will. But in general, I'm not going to trade the first hour the markets are open. for a credit spread, 30 days or less. I want to take advantage of time decay for a debit spread, 60 days or more, because I don't want to take advantage of time decay. I want to give time for the trade to work. These are simple rules, but I would probably slash and change rules to suggestions to help you take advantage of the probabilities of being profitable. And it's usually that simple. I'm not going to push it any more of that. And interesting, actually, there are 3 comments here that I want to touch base, and 2 of them are very similar. Lance, so why don't advisors use the collar trade? So, don't financial advisors always use the collar trade? And last but not, well, let me go through those 2 because those are one and the same. And I do get asked a lot of that. That's Lance and Lee there. So, and I think they're the same question. Basically, guys are saying, so why don't advisors use the collar trade all the time? It always works. It always is protected. It's just time frame that it looks better at times, it looks worse at times, but plain and simple, if you can make up some of the downside movement and you can convert those profits to the downside to shares, you're going to end up with a better overall net return on your portfolio. It's the numbers don't lie. It's plain and simple to show you that over and over and over and over again. Now, the question is, so why don't advisors always use the collar trade? And Lee and Lance, I'm going to tell it to you pretty simply, because people are idiots. Because people are dumber than dirt, and it's always been this way, so it's always going to be that way. They don't need to work any harder because they can give you a line of crap about a mutual fund and it's low cost and it outdoes the market and blah, 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 blah. And you guys, the retail trader, doesn't ever bother to do the research, doesn't ever bother to find out, well, the Vanguard funds seem to be less, but you really have at least 9% charges for distributions and taxes and all the crap they have in those mutual funds. ETFs, well, you don't bother to do your research to find out that it's a Schedule K. And you can get out with a loss and still at the end of the year pay capital gains taxes because overall you are an owner of the ETF for that short period of time. It's sad. It requires work. And unfortunately, no matter what generation you are, there's that necessary evil in life that I think gives us hope that we're still always looking to get lucky, to get something for nothing, to get rich on something that, I don't know, that's by happenstance versus blood, sweat, and tears. It really, there's a lot more work and responsibility, as I see a comment coming in from Kiev. It's a lot more work and responsibility for advisors to have to collar trade when, unfortunately, for all these years, advisors have been taught the biggest and hardest part is just capturing the money. And then if it doesn't make money, it's the market's fault. It's not their fault. And why would they ever want to go the extra mile and take education and learn for you when there are billions of you that just come in and say, here's my money, do what you want to do with it. You know, here's my money, go make me money. So Lee and Lance, no, I'm not calling you out directly. I'm just telling you where the mentality is. And Lee, I know you've taken the time for education. Same with you, Lance. So those comments of frustration are not directed towards you at all. They're directed towards the stupidity of the individual investor that thinks they've done some work sometimes and really haven't done squat. Now, Mary, over to the other question that you're going to ask. So, why are there times I lose in my collar trade? And that comes back down to right above it, Mary. The market is an ever-changing, ever-moving, volatile beast. There are times when you will have drawdowns in your account. If we were to make up every penny on the downside, you would not make any money to the upside. That is the problem with always having long puts and short calls in place. You can't make any money. Rich, I wish I could have a little snippet on your experience with that. If you're overprotected, you're doing a great job protecting your money. Your stock ownership looks amazing. Your stock ownership looks like you're making a ton of money, but you're overpaying for protection with the long puts and the short calls, and that eats away all your profits. Rich and I have had this conversation. It's not necessarily unique to trading, but you always hear people talk about that risk tolerance. And if you're overprotected, and not that I get it right every single time, obviously, but if you are overprotected, you give away your profits because you've paid too much for long puts and short calls. For some people, they just don't want to lose their money. So it's always prevalent for them to have short calls and long puts. For those that need to make some money, you can't live that way. You can't make enough money. You can't make anything, in all honesty, by always having long puts and short calls in place, especially if you had them in the last 10-year bullish bull market we've ever had in the history of the United States. You pissed away a lot of opportunity. And I'm calling it what it is. I'm sorry if I'm offensive to some people. I've just had a couple phone calls yesterday and today that really, really have pushed me in a frustrating direction. 2 comments just came in. You need mucho paciencia in collar trades. You need much patience in collar trades. You do. The advantage of collar trades, it's a slower moving, lets you get your head on your shoulders type of trade. The other comment, greatly appreciated. And obviously, Mary, you've heard me in the past. Collar trades allow me to be wrong, yet still be right in the long term. And that is probably the best way to say it. I might think a stock like Disney should have gone up 3 years ago, 2 years ago, 2.5 years ago. I guess I need to talk to Keeve on this one. I was recommending it at 115, saying it should be at least 142. Well, 2.5 years later, that dang thing's heading to 142. Probably should be closer to 151.5 now. Next Monday, I'm going to have Keeve take care of our commentary, but I'm going to have 4 pretty interesting articles, and one of them, hopefully Keeve will spend a little time with you, that's going to go over Disney and a proper valuation for a cash-rich company that's diving into the technology and or the streaming media. And yeah, I mean, you can, on the low end, I'm going to tell you 151.5. On the high end, you can make a reasonable 175, 1 to 178 is where Disney should be trading. So back to my rules and what kind of pisses me off about this. Here are some that I disagree with at times. Here are some that have cost people dearly. I'm going to get out at a 20% return. Well, that sucks. Why would you get out at a 20% return when you could get out at 100% return? Well, Kevin, you got to capture, pieces of the wave. I agree with that. But I'm sorry, anyone that got out at Disney before their earnings, or excuse me, well, yeah, let's do, and that got out at Disney, Visa, Apple, Baidu, Ford, all that got out their 10% returns at these lows have missed 20, 30% more to the upside. Well, I could have always gotten back in. Key word, you could have. But why would you get back in with the same trade when you have a profitable one that you don't need to spend commissions and you have a higher delta on? Now, I'll concede. You never go broke from taking a profit. Agreed. I will also concede you never make big money if you're always taking 20%, 20%, 20%. There are some times to let things run, which means you don't have a staunch rule that, hey, it's 20% or nothing. No. There are times that you're going to break your rule. There are times that common sense says, I got to let this run. I got to let things go back. Facebook can get back up to 218, Apple to 228, Baidu to 288, Ford back up to 13. Don't take a 20% trade. Don't create a new trade and have a lower delta and create more commissions for you. There are times when you let your trades run or let the trade run. Be willing to do some common sense and not be an idiot following a rule. Think for yourself. Use your best educated decision. It's okay to be wrong. That happens. That's real life. We're not Jesus Christ. We're not perfect. This is trading. It comes with a level of risk. Find your risk tolerance. Find when you can let some things run. Find when you can make a killing. If you're not doing a repeatable process, something you can repeat every single time, which you already know you can't, why would you waste your time creating rules? You already know returns are variable. You already know the process is going to be variable based on what you see at that instant time and moment. Why would you complicate your trading by creating some weird fictitious rules on a process you already know is not repeatable? I'm going to scratch my head there. Oops, I'm going to erase it because I didn't mean to. What else did I have in here? Kind of rubbed me wrong. I had some dummy that told me the rule indicates always, that it always works. And it was interesting because he talked to me about credit spreads and primarily the covered call. It's such a protection-based trade. I net every quarter 2.5%. And it's funny because I had him name some off, and yeah, you know what? He found some that were, for all intents and purposes, nailed it. And then I asked the killer question. Well, will you open up your portfolio? Well, I said, Henry, with all due respect, I call bullshit. Well, I don't like people saying that. Well, use my computer. My computer has more security on it than NASA, for crying out loud, with the Securities and Exchange Commission. Open it up. Yeah, Henry, I call bullshit. And then I asked him, well, what were all the stocks he traded? And all of a sudden, Henry started to do some math. Henry, on Apple, you took a 40%, 42% drop. So you're 2.25% a quarter or 2.5% a quarter. With all due respect, and I'm going to take my calculator here, 42 divided by 2.5. You need 16.8 quarters to make up for the downward movement in your stock. And that's just one stock in your portfolio. That means you had to have 16.8 other 2.5% returns or yields on a covered call that equal apples to break even on your portfolio. Well, Disney's not that way. I've been in it for 3 years. Well, Henry, you're a delusional idiot. Because I can show you from 115 down to 85. And if I take a $30 loss divided by 115, that's a 26% divided by 2.5%. That's 10.4 covered calls. At a point in time, 10.4 quarterly covered calls that equaled your Disney covered call credit to make up for the loss on the stock. And Lance and Lee, I'm going to go back to you. Why don't advisors do more caller trades? And I'm going to make this comment as simply as possible, because retail traders frustrate the hell out of us. And I love my clientele, but there are some people I'm not letting into my clientele because they bug the crap out of me. I can't ever take a Henry. I can't ever take a Maribel. Mary, I've got you, but a Maribel, oh my gosh, I'm going to eat a bullet. I can't remember her name. The Parkers. You'll notice I put in my people that I have that I've picked up through education, I've got my No Parker group here. I've named 35 accounts No Parker. I'm not taking the Parkers. They are freaking ridiculous. Why would you hire someone to trade your money if you know it all? If you question everything, if you lack the faith or the understanding of the trade, oh my gosh, I was getting a call every other hour. I had to dump them. No Parker. Should be no Parkers. I teach myself every day. You make enough money, you've got this group, you've got another group, you've got 401k groups. I don't need Parkers in my life. Now, for those that are clients, hopefully I'm not scaring you because I don't mean to. You guys are fine. If there was a problem, I would call you and tell you. But guess what? I'm to the point in my life, no Parkers. I'm done with them. I'm done with Maribels. Unbelievable. Bill, catch it on the recording. So, what else do I have? I got to find a trade for you guys, right? Let's see what else I have here. I always like to tell you what I'm doing and why. And the short answer is earnings, and there are times stock ownership is important when you just aren't sure. If I was looking for a new trade today, Micron, buy to open shares and add a $44. Let me pull it, let's do it. Let's find out where Micron is at. And a couple of orders did not get filled. What didn't get filled? Buy to expired. Just kind of a bummer. I totally would have thought Baidu was filled. So if I was looking at a new trade for today, I would be going with Micron. I cannot afford it in this account, but no brainer on Micron. I would be buying Micron. I would be adding, pretty sure it's May 31st. Next earnings are the 16th. No, I thought I had the trade for you, and I don't have it. I would have done it yesterday, and as I check things out a little bit more, I don't like it. I don't like Micron like I thought I would. And the reason why is because its earnings are all the way out to June. I thought its earnings were going to be before then, so I could catch. Really, I'm trying to catch a sector run on chips, on the NVIDIAs, on the AMDs, where Micron would follow along with it. But it doesn't make sense to do that and to spend money on protection without the catalyst in the stock itself. I don't think you can get the catalyst just with the chip sector alone. So could have played the bounce. What I may have done yesterday, I would not do today. And that would have been a start around that 42.25 range and run forward. So I mean, you could get into Micron right like this. The problem is you would probably need to also add a covered call in that time frame. So let's work the numbers out. You'd buy the share at 143.45. If I'd open a long May 31st, 19, and I think I chose, let's see where I chose, 43.50. And it's going to cost $2, 195 to 203. I'll cheat on the more expensive side, 205, $2. New cost basis is pretty simple. That's going to be 45.45, right? And here we're going to be at the 43.50 strike. We're going to have a new risk. It's going to be $1.95, right? 45.45 minus 43.50. Right to sell to lower the risk even more. I want to sell a call. We're at 45.45, so 47.50 is where I would go. Probably only going to get 60 cents ish, going on the low side there. Probably only getting 46 cents, which, excuse me, 60 cents. Might as well take a screenshot of this for everyone. And again, one more time, it's not a trade I'm in because of other positions that I am in. I will need to lighten up on Facebook, but I'm going to look to do that as it breaks 200. Sell to open a 47.50, May 31st, 2019. Short call for 60 cents. Overall risk in trade, and that's until May 31st, right? We're looking at the risk of $1.95 minus 60 cent covered call credit equals $1.25. Or if you take $1.25 using my calculator, $1.25 divided by 45, we'll just call it 44.85, 2.78% return, 2.78% risk on total invested capital, risk on total invested capital. Maximum return without adjusting, 47.50 minus a cost basis of 43.50 minus 10, so that's going to be a 45.45, so it's going to be 44.80 is equal to 47.50 minus 44.80 is equal to $2.70, or 270 divided by 44.80, or a 6% return on invested capital. I like it. You know, it's 2 rewards plus for 1 risk. It's pretty simple in here. There you go. It's a good opportunity for, in all intents and purposes, 5 weeks. 5 weeks to make a 6% return on a 2.78% risk. Done deal. Interesting trade. You would be placing this trade following the run up on semiconductors and chips, which really looks to be doing pretty good right now. So with that said, entertaining. Did you guys like to hear me rant and rave today for 34 minutes, but to put it into perspective? Maud, thank you so much. Maud's my favorite, by the way. Guys, there's something about a woman's comments that just melts my heart. Instead of a pure long put, would you consider a put debit spread? I would not. And you might look at me and go, why not, Kevin? Well, you can make a great justification, Abraham, for a 43.50 and then going to a 40.5, a $3 spread, because you do have the 200-day and the 50-day simple moving average. So you really have every justification to do that. The reason behind that is personal experience with Micron, where when it falls below that 200-day, it goes right to the 50, and because the 50 is so close, I would worry if I had an AMD. I was going to say SanDisk, but they got bought out. AMD, Intel, Qualcomm. If someone makes a comment about chips and how bad they're going, or there's an issue with China, it's going to fall right through that. So I would not, but you have two justifications that the 250-day will hold, not to mention any announcement of a trade deal from China shoots this up significantly higher. So it's not a bad idea, and it makes perfect sense to do the 43.50 long put and to sell a 40. That actually might make you a little extra credit, which will give you a great return in all honesty. But so here's the deal. If I was to do that, it would definitely fall right on through. For me, I guarantee you, if I was to do that, it would fall right on through. But you could sell a put and pick up an extra 75 cents. That really does increase the risk in your trade. But man, in all honesty, that's a great idea. Mathematically, no brainer. You've got two huge technical support levels at the 250 day. It gives you another 75 cents of credit. You do have a heck of a lot more risk, but you also have a heck of a lot more return on a percentage basis. So I guess what it comes down to, Abraham, great idea, great trade. I personally would not be doing that. I would go ahead and I would give myself unlimited downside protection because Micron hates me as an individual. I guarantee you, I put the spread on like that, it drops to 37.50 overnight for some reason. But the way you just calculated that, excellent. Great thinking. That would be a smooth, good-looking trade. I personally cannot pull the trigger because of my personal risk tolerance and past experience with Micron. But I would love for you, if you can afford it, to put the trade on and to come back to me and tell me how it works. I really would love to see it. E-Trade does not offer paper trading, so I can't do a paper trading trade just to do it. I'd have to place it. But I really would love to see how that one works. That is very intriguing to me. And Abraham, if you did do it, would you take some screenshots and keep me posted? Because that would be, I would really like to follow that one along. That would be interesting to me. Keith says they do have paper trading in now. So I don't see it, Keith. Keith works with Hurley Investments. He is the Coda investment arm. I don't see paper trading for me, Keith. I'm waiting for him to talk to me to show me. You have to go to the main site. I'm on the main site. So there's my launch pad. It's funny. Keith goes, it shows me on mine. Well, Keith, I've been licensed, bonded, insured long enough that they're like, no, we're not giving Hurley any paper trading to show people what he's doing. He's got to show real trades. Keith, if you wouldn't mind, would you stick that trade on your paper trading just to see what it is? That's one I would like to follow along with, but and since you guys are going, come on, Hurley, what are you doing? I'm chock full. It's a small account, $37,000, but I've got Boeing I'm hanging on to. like an idiot. I sold off my long put, so my cost basis overall is now $4.75 on my bull call verticals on Boeing. BNet shares, I kind of got talked into these guys. I just have them. They're a long wild shot of I don't even know I have it. I just have it. Let's be simple there. Kiev, 100 shares of Micron, May 31st, a 43.50, 40 short a bear put, and a 47.50 short call. So it's a 43.50, 40 bear put and a 47.50. You could technically raise this up to a 40.50, but only for a dime to take 50 cents more risk. I'd put it at 40. So it's 100 shares, a 43.50, 40 bear put for May 31st, and a short call at 47.50, Keith. All right. Disney, I've got my Disney long calls. I thought I had 35s in there, but boy, just a couple days, that's netting me. There's a nice return already. I've got Ford Leap calls. I've got Facebook that I'm way over leveraged in, that I'm ready to take some profit off of it. I've got Under Armour that, in all honesty, why the heck do I have 21 puts in place? That doesn't make sense. So I probably did an oops there. I shouldn't have 21 puts. Next earnings confirmed 5.2. Sometimes I dork around and don't know why I have that one there. And then I've got my Visa Leap long calls, which have treated me very nice over time. If you were to look at my summary, I'm pretty sure I'm in some margin. I'm in some margin by about $2,500. Under 10%, I can live with that. Facebook, I will lighten up on some Facebook calls here, but I will do that when Facebook. 93. I'm going to wait till closer to 200. I think Facebook can get to 200 pretty quickly. I still have, pretty interesting, I still have those positions out for forever. How many days are they? 400 some odd days. Facebook, June 20. Pretty sure it's like 430 days. So I can sit on those Facebook calls for quite a while. 421 days out to June. So no need for me to get upset or tweak those around right now. All right, guys. Hey, have a wonderful day. Hope you enjoy this. I'll get this posted most likely tomorrow. Take care, and I look forward to seeing you next week. Keith will take care of Monday. I will see you on Tuesday and Thursday next week. Y'all have a great time. Hopefully you'll listen to this 2 or 3 times and get a chuckle or you hear my frustrations, and I'll talk with you later. Bye-bye.